Okay, so today's Cardinal lesson is titled Annuity Income Rider Explained. So it sounds pretty simple. You put a rider on an annuity policy, and then that rider gets you an income. And once the income starts, it's guaranteed to pay you the amount of the income for the rest of your life. So what we wanted to do today is just focus on the annuity income rider. And we have these from probably 50 different insurance companies that sell annuities that have an income rider that we can attach to their product. And so we're just explaining one of them to you today. And these things are all fairly similar. They have different ways they go about doing this, but we're going to try to just walk you through this so you get the point of what an income rider is and what it can do for you. Now, I'd like to bring Tom on. Tom is really going to share with you why we're shooting this video today.
Yeah, I mean, we're doing this video because when you retire, income is more important than the assets you have. Your assets are important, but to the extent of what income they can produce for you to live in retirement, because your paycheck has stopped and you need some money. And so, what we use a lot of times in our planning is we use annuities, not with all of your money, but with a piece of your money. We include an income rider, which we're going to explain here in a second, to create a guaranteed income that will last the rest of your life. If you're a couple, the rest of both of your lives, and it's guaranteed. It doesn't matter what happens in the markets. It doesn't matter what happens with interest rates, what happens, politically or geopolitical issues. It does not matter at all. This income is coming in guaranteed, even on a zero account balance. So this is something that's very useful. A lot of times we have videos where we do these big illustrations. We show all these moving parts of the annuities. Really, this piece that we're going to talk to today, this is the reason we're recommending the videos. It's not all the moving parts. It's not the bells and whistles. It's the guaranteed income for the rest of your life. This is what we're solving for. We want to get the highest income we can for the rest of your life. So let me bring up the show notes. We have these at the link below our video. They're also on our website in the show notes section. We have the board, and then we have a couple charts. We're going to come back to this later in the video. But this is really where we got the details from the board. This explains how the income rider works for this particular policy. But again, we'll get to the examples, and then we'll come back to these and show you how they work in a little more detail. So I'll turn it back to you, Hans.
Okay, so just have 6 bullet points, 3 before the examples, 3 after the examples. Number 1, once you elect income, and it's you electing the income, it's not the insurance company. Once you elect income, the income lasts for your lifetime. So if you buy a single one of these, you're 65, and most of the people that purchase these don't start the income right away. In fact, if you were going to start the income right away, we'd probably recommend a different one than this one, because there's some of these 50 companies that we sell these income riders for that actually have their policy to set up to pay out better if you start the income right away. So this one performs best if you leave it there for 3, 4, 5, 6, 7, all the way up to 10 years. That's kind of the sweet spot in there for getting a substantial income that's paid out for the rest of your life. So once you elect the income and it begins, you are now going to receive a check monthly if you elect that for the rest of your life. It's just going to pay out regardless of any performance. Number 2, lifetime income for 1 or 2 people. So we can put this rider just on one person, which is you, or we can put this rider on covering 2 people, and the second person needs to be married to the first person. Okay, and so now we're insuring 2 lives, and you get a little less in income if you're including the lifetime of your spouse. But the upside to that is, like for my wife and me, I mean, I think that she's going to live up into her 90s, maybe even past 100, like her aunts have lived. I don't think I'm going to be around that long. So once we turn the income on this thing, at some point when I pass away, she's going to live on maybe for a lot of years, getting a check out of this annuity. And if that in fact plays out that way, this is going to be one of the good decisions that we made in our retirement. So you can start the income, it's your choice, from year 0 through year 10. I mean, most of the time when people buy these things from us, we have recommended that they start the income at some point in the future. Like some people want to start it at 73 when minimum distributions start. Some people want to start it after the full 10 years has had the benefit of increasing the amount that they're going to get. Some people just have different points where we pick and say, okay, we're going to start at this point. How much are we going to get? And then we're going to show that income in the financial plan lasting for either one or both of their lifetimes. But you don't have to stick with your original plan. Once you get this plan started, and you can pick any one of these years, year 0, I mean, like starting it right away, all the way through the end of year 10. You could even pick beyond 10, but typically this particular income rider on this particular annuity doesn't really perform well to leave it there 15 years. So we have other companies that actually keep higher step ups to 15 years. So we would direct you to a different company. But for the purposes of example, we're just showing you years 0 through year 10. Now, in these examples that we have up here, we have a single man or woman, it could be either one, age 65, and we're showing you $100,000 where you're going to pay that into the annuity. You're going to set that aside. This could either be IRA money or it could be regular savings. And then the plan is to leave it there for a while, for a number of years. And we're going to show you, based on the original $100,000, if you started it right away, you would get a $7,100 annual income for the rest of your life. If you waited a year, or actually waited till your next birthday, you'd get a $7,800 a year income for life. If you waited till your second birthday after you bought it, you'd get $8,590 a year for the rest of your life, and so on. I'm going to jump ahead here a little bit. If you waited till the 8th year, you'd get $15,210 for the rest of your life. And where this thing performs quite well is that if you waited till the end of the 10th year, the beginning, well, actually, you waited till your 10th birthday after you bought it, the day after that, 18,410. My point is we can pick one of these to do a projection, but you don't have to stick to it. Is if you wanted to start it in year 3, you just are going to call us up, we're going to do it, or call the insurance company up. If you had projected to start in year 5, but we get to year 5 and you say, I think I want to wait a little bit, I don't really need the money, I'd like to wait a little bit and then have a higher amount, that's totally within your choice when you actually start it. And these amounts are not going to change no matter what the market does, no matter, I mean, it's just these percentages. And so I want to go back to Tom, and I want Tom to show you how you could actually, if your age is not 65, if you wanted to go. So I want to bring Tom back on, and I want him to show you in the show notes how you could do the math yourself.
Yeah, so we're going to go back to the show notes. I'm going to go through these charts here pretty quickly, or maybe not so quickly, try to show you how it works. But you have, I'll point out there's 2 charts here. One is based off a single lifetime payout. Just notice that in the top left corner. And then one is on a joint lifetime payout. They're different numbers. And so you need to make sure you're looking at the right chart. If you're buying this on yourself, this is the one you look at. If you're a couple, you look at this one. So let's do a single payout. The highlighted areas are what we have on the board. So you're 65 when you purchase this. This particular, how this income rider works is with Midland National is the insurance company. Other companies have similar riders. They work a little bit differently, but they're all fundamentally doing the same thing, is guaranteeing a known amount in the future that you know when you purchase it. How Midland does it is they look at your age when you buy it. So in this example, 65. If you're a different age, you'd go to a different column here. So let's do a 60-year-old as an example. You're 60, and then you look at the number of birthdays. That's on the y-axis. The number of birthdays since issue. So if you purchase the policy when you're 60, and a month later you have a birthday, you would drop down to the you've had one birthday. So as soon as you turn 61, you go up to this one. This is a little unique to Midland. A lot of companies make you wait a full year to get sort of that next bump up, but that's just sort of, I don't want to get too into the details there. But you literally look at the number of birthdays you've had, and then you go over to the percentage, and this is the percentage of the initial premium you put in. So if you put 100,000 in, you're 60 years old. You wait 5 years till your birthday when you've turned 65. You get 10.57% of the 100,000, which is $10,000 a year of income. And so that's how the chart works. Again, on a joint payout, same kind of deal. You look at the age of the youngest spouse. So even if Hans and Rhonda, Hans is a little bit older than Rhonda. If he purchased one of these policies with his IRA, which is totally fine, we have a lot of people purchase with IRA. Rhonda cannot be an owner on this annuity because it's not her IRA. But because she's a joint covered person, is how they title it. They would look at her age of when this was purchased. They would go the number of years between when her birthdays in that example, and they would go find the chart. So that's how this one works. Print out the chart. You can look at it. If you look at this chart and you're like, man, there's so many numbers, I don't know what I'm looking at here. They do have a website, this income planning calculator. You don't need to log in. You don't need to put in your information. If you go there, you can actually run the numbers for your specific situation, put in the amount, and it will show you. I mean, what it's doing behind the scene is just this. But if you don't want to worry about this, go to this website, and it will help show you how to do it. I will point out this particular product in Midland is not available in all 50 states. It's available in most, but not all of them. And these rates are subject to change, right? Periodically, they'll change these payout rates. So depending on when you're watching this, it could be a little bit different. But as of the time of filming, these are the current payout rates for this particular policy. And again, there's lots of other ones that offer similar type of benefits.
Okay, and I want to add that somebody that purchases this policy from us or anybody else in the next few months, these rates probably are not going to change in the next few months. They're locked in. Their rates are not going to change. These numbers, so if you purchase based upon this, you've got this for the rest of your life. When Tom talks about the rates could change, you could call us up in 6 months or a year and you could say, boy, I was watching that video you made back in the summer last year, and I'd like to shop for that annuity. You might get a different rate than we're showing you on the board or you're looking through in that chart, because the company will from time to time change these amounts. They have some ebb and flow with the actual interest rates that are out there in the market. So just make note of that. This isn't in every state, and the interest rates could be different when you ultimately call in and want to take a look at one of these things. And so we don't calculate these by hand ever. We had to go through preparing for this video and find the chart, pull up, make sure it was current, go through the math of doing it again. So we go to the calculator, and we have a more advanced one but I would encourage you that it's pretty simple. If you want to play around with this, or you want to say, I want $3,000 a month to start when I'm 72, and you put that in the program, it'll work backwards and tell you how much money you need to stick in the thing. So you could play around with that a little bit. You can always call us. And if you got a question or something about this video, just go ahead and put it in the comments, and we'll reply to you. And if necessary, then we'll get together after that. So what we've put up on the board is the single rate. And then what I've done here as well is I've put the numbers for a couple. So, and this would be a husband and a wife, both 65. And you can see that the rates are a little bit lower because now they're insuring 2 lives. So if one person goes early or midterm in their 80s, and then the other one lives up into their 90s, they're going to keep paying out whatever this payout number is, as long as either one of them is alive. So potentially this could be a lot better. We've run into clients that have bought these income riders from other people where we have clients coming in and say, oh, I already got one of those. And a lot of times they're only written on one life, which is kind of like making your pension payout as long as you're alive and leaving your spouse with nothing. So we always, when people are married, we're very much liking to do these types of things, which protects their spouse. Okay, so on with some of the details. The income payments are deducted from the cash value. So if you actually bought this annuity, you were 65, and you put 100,000 in there, and then you waited 10 years to start drawing out the 18,410, well, this 100,000 will have grown quite a bit in the 10 years. We're not going to get into that piece of it here on the video, but let's just guess that it goes to 140,000. It's a very conservative thing, but let's just say that the number has 140,000. And then the very first year, which is the 10th year, but the first year of income payments, we're going to deduct 18,410 from the 140,000. You can see that it's not going to take that long for the thing to get depleted, like another 10 or 12 years. Your annuity is going to be out of money. I mean, you're going to be 86, 87, or one of the two of you, if we do this couple, where it's a $16,000, 660 check. So that's been going on for like 10, 11, 12 years, and your fund has gotten to zero. Well, that's when you get into the insurance company, Mike, because this check continues on no matter what's in the cash value. So just want you to be clear that the money's coming out of your money in the first several years that you're using the annuity value. But if one of you lives or you live longer than the money does, you're still getting checks and you've gotten into the insurance company's pocket. So the second bullet, or the fifth bullet that's down here, income payments from the insurance company after the cash value equals zero. So I already stated that, is that, when the cash value of your annuity gets to zero, you still keep getting checks. They're just coming out of the insurance company's money. And then if death occurs with the cash value remaining, that amount is paid to the beneficiary. So like if my wife and I both bought these and we're going along and we don't even make it to the level where we're starting the value, well then whatever's in that annuity, whatever it had grown to, is going to be paid out to our beneficiaries. Now, if we had kept it, started the income, but then only lived a couple of years past that, there's still going to be some money remaining. So this money isn't gone until you actually draw it all out and get the balance down to zero. And if you outlive the money, you still get checks. Okay, I want to bring Tom back on, and I want Tom to just give us some more thoughts on all the 6 bullets.
I mean, ultimately, the reason you're purchasing this is to have a check that's coming in the rest of your life, guaranteed. And so it really is, it's longevity insurance is ultimately what you're insuring against, is living too long, outliving your money. The real beauty of this is if the account balance goes to zero, you're still getting a check. Whereas if you had investments in traditional investment stocks, bonds, mutual funds, ETFs, and that account balance goes to zero, that money's gone. There's nothing else sending you a check. You're out of money in that scenario. And now you have to live off maybe your social security. Maybe you have a pension. Really, what we've done with this, with our planning, is we've set some of your money up. Again, not all of it, but a piece of it. Having a check that's coming even on a zero account balance later in life is wonderful. And so I think that it's useful for a planning tool. It's not right for everybody. It needs to be built as part of a larger plan. So reach out. You can comment on the video and we can talk more about what that looks like. But at the end of the day, this needs to be, when doing this, it needs to be recommended as part of a larger plan and not just like, oh, put 100,000 here because we told you to, right? It needs to be, a lot of times we're using this or we're solving for an income need that they have and covering it with some of their assets they have. And it just works out really well. So I think it works great. And the math, I can show all the math behind it. It helps with, probability of success and all that stuff. But I don't want to get too far in those details. Really, today, we just wanted to explain a little bit underlying these annuities we use, how the income rider works.
Okay, so within the context of comprehensive financial planning, we compared this lifetime guaranteed check to Social Security check. You can use an IRA to fund these things, or you could use other money. We have talked about income, and it's guaranteed income for life. And we've talked about estate, that if you wind up not living long enough to get the full benefit out of these things, the principal is returned to your beneficiaries. And with that, I want to bring Tom back on. I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening.
Thank you.